is Heather Proctor with Camellia Capital Management. Today's video is on natural gas prices thus far in 2022 and where we think natural gas prices are headed next. We've been bullish natural gas for much of 2022 in the Optimus Fund starting in January this year. Reasons being average U.S. heating degree days started to rise, resulting in more withdrawals from U.S. gas storage. U.S. gas and underground storage was at its lowest level since 2019, and there was an increase in residential and industrial power demand for gas. February 24th, the war broke out in Russia, and gas rallied to over $10. Russia was the world's leading exporter of natural gas and supplies 77% of European gas, primarily via the Nord Stream pipeline. And as you can see from this chart, the pipeline flows have plummeted. The U.S. and other countries have been doing their best to replace Russian gas with LNG. By the way, LNG stands for liquefied natural gas, and before natural gas can be exported, it needs to be turned into a liquid, which makes it easier to ship. Once the LNG arrives at its destination, it's then regasified at the arriving country. The problem is we're limited by a lack of infrastructure to export more LNG than we already are doing. We don't have the capacity to export anymore. And part of this is due to investment capital being diverted from oil and gas infrastructure to green initiatives over the last decade or so. In June, the Freeport LNG facility had an explosion, and once that happened, our long conviction began to deteriorate. So, while at first glance you may think the explosion was bullish, it was actually bearish for gas, and here's why. Freeport's one of the largest LNG export terminals in the world, and it provides around 20% of U.S. LNG processing. It's a huge facility. And when Freeport shut down, it took out about 1% of U.S. natural gas demand, or 2 BCF per day, because we could no longer ship that LNG to Europe or Asia. And since we couldn't do that, we couldn't take advantage of high gas prices overseas. Therefore, U.S. gas prices dropped considerably right after the explosion. At the same time, European prices rallied strong. And in the chart, you can see after both the war broke out and the LNG explosion, European and U.S. gas diverged significantly for a period of time. The blue line is TTF, which stands for Tidal Transfer Facility. It's the main benchmark for natural gas in Europe. The benchmark price in the U.S. is the Henry Hub, and this price spread is known as location or basis risk. It plays a huge role in understanding gas pricing, and it's a topic we'll dive into more in another video. Until more export capacity is built in the United States, we expect that U.S. and European prices will become disconnected at times. Statistically, September is a month when natural gas prices reach their seasonal low. It's the rebalancing period when inventories are building to prepare for winter demand. As this chart reflects, the natural gas low price for the year has overwhelmingly occurred in September. At the end of August, we flipped back to a short position and remained short predominantly through late October. And here's the reasons why we flipped to short. Mild weather and poor fundamentals. Inventory buildups during the shoulder month, delays in Freeport reopening eroded LNG demand. Also, if you look at the chart, the blue line is the RSI, which is relative strength indicator. And we use this to identify overbought and oversold regions as well as divergences between the RSI and market prices. In August, when we went short, the RSI in natural gas was overbought, which indicated a good time to short, because that means the market is running out of buyers. We'll get into RSI and how it can enhance your trading strategy in another video. So we were short predominantly from the end of August through the end of October. And at the end of October, we actually reversed positions again and went back long natural gas, and we've remained long predominantly since then. The reasons are mixed between fundamental, technical, and macro. We've had heating degree days continue to be well above the 10-year average, and additional demand from the power sector leading into winter. Inventories dip back below their 5-year average. We've had positive momentum. On the next slide, you'll see how the RSI got down into what we would consider oversold territory, and it gave us a good opportunity to re-enter from the long side. So here's a recap of how our positions changed in natural gas over the past 11 months and how we wound up long and have remained predominantly long since then. Going forward, exports will be important to watch as we monitor the situation in Europe heading into this current winter demand season. The U.S. has already agreed to double exports in 2023 to the United Kingdom in an effort to maintain adequate energy supplies in the UK and Europe. The recent weakness in the US dollar has been supportive of natural gas prices. We're going to continue to monitor the reopening time frame of Freeport, and we'll continue to track key technical and sentiment signals such as RSI and the commitment of traders, which tracks open interest by trader category. Winter weather will be key in that if we have a warmer than normal winter, degree days will drop and likely cause our position to flip back to short. Camellia Capital Management is an alternative asset manager with a focus on the commodity investment space. We manage a portfolio of energies, metals, grains, livestock, softs, and ESG related products on behalf of institutions. And feel free to reach out to either Rick or myself if you'd like to learn more about our approach to investing in natural gas or our commodity fund. Thank you.